Imagine getting a slice of income from huge shopping malls, apartment buildings, or even those cutting-edge data centers without actually buying the whole property yourself.
Right.
That's kind of the world of REITs, or real estate investment trusts. They let you tap into the power of commercial real estate income and diversification, often with, well, surprising benefits.
Benefits that most people maybe don't fully appreciate, I think. And they definitely come with their own complexities, their own analysis requirements.
Yeah, it's essentially the public market's way of, let's say, democratizing access to these really large-scale real estate assets, stuff that's usually way out of reach for individual investors.
Exactly. You get exposure to these valuable income streams, the growth potential, all through a structure that feels, more like investing in a regular stock than physically buying a building.
Exactly. And today we're doing a deep dive into U.S. REITs. We're really pulling apart what they are, the vastly different kinds of real estate they invest in, and most importantly, those key metrics you absolutely need to understand.
Metrics that are quite different from standard stock analysis, yeah.
Right. We need to figure out how to analyze them effectively. We've got a stack of sources here, articles, research, and we're going to unpack the essential insights so you can feel, hopefully, truly well-informed about this fascinating and sometimes, let's face it, misunderstood asset class.
Yeah, we'll cover the core concepts behind the REIT structure itself, explore that diverse landscape of sectors where they operate, and then really dive deep into those crucial, specialized analysis metrics you just have to use.
Okay.
And then we'll touch on broader things like the significant risks involved and maybe some potential strategies for investing.
Okay, let's unpack this then. First off, let's get the foundation right. What exactly is a REIT at its core? And what makes it different from just buying shares in, I don't know, any other company that just happens to own some buildings?
Okay, so at its heart, a REIT is a company specifically set up to own, operate, or sometimes finance income-producing real estate. The key difference, like you said, lies in its legal structure and the requirements it has to meet for special tax treatment under IRS rules. Think of it less like a typical operating company and more like an investment vehicle built around real estate assets. So when you buy shares in a REIT, you're essentially buying a piece of a company that owns and manages this portfolio of large, often institutional-grade properties.
So like massive distribution centers, high-rise offices, big apartment complexes, stuff I couldn't buy myself.
Exactly. Stuff you couldn't possibly buy on your own.
So I'm not buying like one specific apartment unit or a corner store. I'm buying shares in a company that owns maybe entire apartment complexes or whole shopping centers. And the key is that tax treatment you mentioned. What are those specific IRS requirements?
Precisely. And yes, the tax structure is absolutely fundamental. To qualify as a REIT, and importantly, to avoid being taxed like a standard corporation, these companies have to meet some very specific requirements. A big one relates to their assets.
Right.
They have to invest at least 75% of their total assets in actual real estate assets or cash, or maybe U.S. Treasuries. This basically ensures they're primarily focused on real estate itself.
Okay, 75% of assets tied up in real estate or cash. That makes sense. What about where their money comes from, their income?
Also strict rules there. At least 75% of their gross income has to come from real estate-related sources.
Yeah.
So that means things like rents they collect on their properties, interest they earn on mortgages they might hold or finance, or gains from selling real property.
Right.
It just reinforces that real estate focus, but from the revenue side too.
So the vast majority of their money made and their assets owned have to be directly tied to real estate activity. But okay, here's the one that really seems to define them for a lot of investors.
Yeah.
That dividend requirement.
Ah, yes. And this is where it gets really interesting and, frankly, drives a lot of their appeal for income investors. They must distribute a minimum of 90% of their taxable income as shareholder dividends each year.
90%. Wow.
Yeah. And note that's 90% of taxable income, which isn't always exactly the same as their operational cash flow metrics we'll get into later, but still it's a very, very high payout threshold compared to most traditional companies.
90%. That is huge compared to regular companies that might just reinvest most of their earnings back into the business. Why? Why are they basically forced to pay out so much?
Well, that hefty payout requirement is kind of the price they pay, so to speak, for a major tax advantage. By distributing at least 90% of their taxable income, the REIT itself generally avoids paying corporate income tax. Think about a regular corporation, right? It earns profit, it pays corporate income tax on that profit first, and then, if it decides to pay dividends out of what's left, the shareholder pays income tax on those dividends again. People often call that double taxation.
Right. I've heard that tax at the corporate level, then tax again at the individual level.
Exactly. But a REIT, because it pushes almost all of its taxable income out the door to shareholders, largely avoids that first layer of corporate tax. The income is essentially taxed only once, mostly at the shareholder level when they receive the dividend.
I see.
This pass-through structure is fundamental to the REIT model, and it's why they are often seen as high-yield investments. The money that, would have gone to corporate taxes is instead distributed to shareholders.
Okay, so the corporate tax is largely skipped. The income flows through to the investor, and then the investor pays the tax on the dividends. That definitely explains why they often have such high dividend yields, potentially much higher than average stocks.
That's the mechanism, yes.
But does that high payout structure have any downsides? For the company itself, I mean. Does it limit its ability to grow by reinvesting its earnings?
That's a really insightful question. And it's absolutely a key consideration. Because they are required to pay out so much, REITs naturally retain significantly less cash compared to other types of companies. Companies that might reinvest 50%, 80%, maybe even 100% of their earnings back into operations, R&D, new ventures.
Right.
This means REITs often have to rely more heavily on external financing, like issuing new stock or taking on more debt to fund major growth initiatives, things like acquiring new properties or developing big new projects. So while that high payout is great for current income, you're right, it can sometimes temper their ability to compound growth purely from retained earnings.
Okay, that provides really important context for when we think about analyzing their growth potential later. Beyond the income, though, you also mentioned diversification earlier. How does that work?
Yes, absolutely. REITs offer portfolio diversification for individual investors, primarily because they provide access to large-scale commercial real estate without needing the, frankly, massive capital outlay required to buy a property directly. You can invest in a diverse portfolio of properties across different sectors, different geographies, with a relatively small amount of money, just by buying shares of a REIT. It's a pretty easy way to add a different asset class real estate to a portfolio that might otherwise just hold stocks and bonds.
Plus, unlike trying to sell a building, which can be incredibly difficult and take ages.
That's a huge practical benefit, yeah. Publicly traded REITs are highly liquid compared to physical property. Most trade on major stock exchanges all day long, meaning you can buy or sell shares fairly easily, fairly quickly.
Yeah.
Completely unlike trying to sell a multi-million-dollar office building or apartment complex. That can take months, sometimes even years.
Okay. Looking back historically then, how have these U.S. equity REITs actually performed as an asset class? Have they been, worth it?
Historically, yeah, they've shown pretty strong performance, often providing both competitive returns and that valuable diversification we talked about. According to figures cited in our sources, the FTSE Nareit All-Equity REIT Index, that's a common benchmark for U.S. equity REITs, it had an average annual return of about 5.70% over the 10 years ending March 31st, 2025.
Okay, 5.7% over 10 years. What about longer term?
Even better. A robust 9.90% average annual return over the 25 years ending on that same date.
Wow, 9.9% over 25 years. How does that stack up against, say, the S&P 500 over that longer period?
Well, over that same 25-year period, that 9.90% average annual return for equity REITs actually outperformed the S&P 500 7.41%. And it also beat the Russell 2000's 6.83%.
That's significant outperformance.
It is. And like we mentioned, they've historically offered better yield than traditional fixed income, too. Now, obviously, you'd consider both real estate and fixed income if you're seeking yield, but REITs offer that potential for capital appreciation, too, tied to property values and operational growth. Fixed income generally doesn't offer that upside.
That's a very compelling track record. Makes a strong case for at least considering them. Okay, so we've covered the basic concept, the tax-advantaged high dividend structure, the historical performance. Now let's explore the landscape a bit more. You mentioned different kinds of real estate. It's not just one big blob, right? There are distinct sectors.
Absolutely not one blob. The world of REITs is incredibly diverse. It reflects all the different ways real estate is used commercially. Before we dive into the specific property types, though, it's important to make a broad distinction between equity REITs and mortgage REITs. Our focus today is mostly on equity REITs.
Right. Equity REITs are the ones we've mostly been talking about, the ones that own and manage the actual physical property.
Yes, exactly. They own and operate income-producing real estate. They get their revenue primarily from collecting rent from tenants and sometimes from selling properties. Mortgage REITs or AMITEs, they're quite different. They don't own physical properties in the same way. Instead, they provide financing for income-producing real estate. Their income comes from the interest they earn on mortgages and mortgage-backed securities they hold.
So they're more like lenders.
Kind of, yeah. Because they deal with debt instruments and they often use leverage, their performance is heavily tied to interest rates and credit risk. Analyzing them requires a totally different framework than equity REITs.
Got it. Okay, so equity REITs are the main focus today. And within equity REITs, there are numerous subsectors based on the type of property they own, each with its own economic drivers and sensitivities.
Precisely. There are many different property types, and understanding the dynamics of each sector is really crucial because, well, their performance is tied to different parts of the economy, different trends. Let's maybe take a quick tour through some of the main ones mentioned in the sources and talk about what influences their success and what to look for.
Okay, sounds good. Let's start with retail. That's often what people picture, right? Shopping centers, malls.
Yeah, retail REITs own properties like large regional malls, smaller shopping centers, maybe anchored by a grocery store or pharmacy. Their income, primarily tenant rent. Often leases have a base rent, plus maybe a percentage of tenant sales if they do really well. The big challenge here, and it's been a challenge for, over a decade now, is that massive shift to online shopping.
Right. E-commerce.
Exactly. It's put immense pressure on many traditional brick-and-mortar retailers, and consequently on the landlords, the REITs who own the properties they occupy.
So if I'm looking at a retail REIT, what specific things should I be digging into to understand its health in this, pretty challenging environment?
You really need to look beyond just the headline numbers. Focus on the type of retail property they own. Are they focused on properties with strong anchor tenants that are more resistant to e-commerce?
Like grocery stores, home improvement?
Exactly. Grocery stores, home improvement stores, maybe discounters. Places people still physically go to. Those tend to be more resilient. Contrast that with REITs heavily invested in, say, traditional enclosed malls that rely on struggling department stores or apparel retailers. Those are tougher.
Makes sense.
You also want to see evidence that the REIT's management is being innovative. Are they finding ways to fill space left by struggling retailers? Maybe converting empty anchor stores into offices or apartments or even entertainment venues to drive foot traffic?
So adapting the space.
Adapting, exactly. And look for strong balance sheets. Good cash position. Why? Because in a distressed market, the strong REITs can actually acquire valuable properties from weaker players at attractive prices. The core insight here is tenant health and adaptability are everything, and management's ability to remix that tenant base and property use. If the retailers are struggling, the REIT feels it directly. Vacancies, lost rent. It's unavoidable.
That makes perfect sense. The landlord's success is just completely linked to their tenant's success, especially with retail changing so much. Okay, how about residential properties? Apartments, maybe?
Right. Residential REITs, they own and operate apartment buildings, sometimes single-family rentals, even manufactured housing communities. Success here is highly dependent on macroeconomic factors, demographics, particularly things influencing housing affordability and where people are moving.
So you mean like places where it's really expensive to buy a house?
Precisely. The best markets for residential REITs often tend to be where the cost of buying a home is super high relative to average incomes. That basically forces more people to rent. The sources use classic examples like New York City or Los Angeles. Persistent high housing costs create this deep pool of potential renters, and it gives landlords significant pricing power.
Oh?
You also want to look for REITs operating in markets seeing strong population growth and job growth. When people are moving to a city for jobs, the economy's expanding. That increases demand for all housing rental and owned.
So what are the key indicators to track there?
Falling vacancy rates are a good sign. Rising rents in the REIT's specific markets, those are strong signals. Demand is outstripping supply in their properties. And again, management's ability to operate efficiently, maintain the properties, and critically, access capital to buy more properties in these desirable growing markets. The key point is, demand for rentals is fundamentally driven by housing costs versus income, interest rates affecting home ownership, and the overall economic health and migration patterns of that region.
Okay, so retail and residential seem pretty tied to consumer behavior and broader economic health. What about healthcare properties? That feels like it's driven by different, maybe demographic trends.
It is, yeah. Healthcare REITs invest in a whole range of properties essential to the healthcare system. Think hospitals, medical office buildings, skilled nursing facilities, senior housing like assisted living or independent living. Their income often comes from long-term leases or sometimes occupancy fees paid by the companies operating those facilities.
And those operators rely on payments from Medicare, Medicaid, insurance.
Exactly. Medicare, Medicaid, private insurance, or people paying directly out of pocket.
Okay, with the population aging in the U.S. and other places, that sounds like a sector with a pretty strong built-in demographic tailwind, right?
Yeah, that's definitely the opportunity. Absolutely. The aging population is expected to significantly increase demand for healthcare services and the facilities that provide them, especially things like senior housing and skilled nursing. However, and this is a key risk mentioned in the sources, there's significant uncertainty around healthcare funding. Changes in government programs like Medicare or Medicaid reimbursement rates or big shifts in the insurance landscape can drastically impact the profitability of the facility operators. And if the operators struggle, well, that affects their ability to pay rent to the REITs.
So for a healthcare REIT, you'd want to see diversification, not just different property types, but maybe different types of payers too.
It's exactly right. Diversification is crucial here. Across facility types, hospitals, medical offices, senior housing, across geographic locations, and importantly, across the operators who lease the properties, and ideally even across the funding sources, balancing that Medicare-Medicaid exposure with private pay options.
Okay.
You should also look for management teams with real experience in the healthcare industry itself, not just real estate. They need to understand the nuances of this complex sector. And, like others, strong balance sheets, access to low-cost capital are vital for funding new developments or buying properties in good healthcare markets. The takeaway: aging demographics are a powerful long-term demand driver, yes. But that regulatory and funding uncertainty in the healthcare system, that's a significant ongoing risk investors have to weigh carefully.
Got it. And what about office buildings? That sector has certainly been, well, front and center with all the changes in remote and hybrid work lately.
Oh, absolutely. Office REITs. They own everything from downtown skyscrapers to suburban office parks. Historically, their income relied heavily on long-term leases, 5, 10, even 15 years sometimes. That provided relatively stable income streams. Traditionally, their success was heavily influenced by the overall economic cycle, especially unemployment rates.
Right. Lower unemployment, companies hire, need more space, higher unemployment.
Companies contract, maybe go out of business, less demand for space. Pretty straightforward link.
But now, of course, vacancy rates seem like an even bigger factor, maybe decoupled somewhat from just unemployment due to those changing work patterns.
Absolutely. High and rising vacancy rates are a major headwind now, directly impacting the REIT's income and, frankly, the value of its properties. And the economic strength and specific dynamics of the location are incredibly critical, perhaps more so now than ever before. Well, the sources mention, pretty pointedly actually, that in this challenging environment, it might be better to own even just average quality buildings in a truly dynamic, resilient economic hub. They use Washington, D.C. as an example, with its stable government sector and diverse economy, than to own prime, top-tier space in a city facing significant economic decline, or really struggling to adapt to new work trends.
Interesting. Location, 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 but with a twist.
Kinda, yeah. And access to capital is still important for building upgrades, to attract tenants with modern needs for collaboration space or tech infrastructure, and potentially for acquisitions in stronger markets if they can find them.
So economic cycles, remote work trends, the specific vitality of the location, they're all kind of colliding right now to shape the future for office REITs.
They really are. Demand for office space isn't just a simple reflection of economic health anymore. It's deeply intertwined with these fundamental shifts in how and where people work. It makes analyzing office REITs particularly complex today. You need to really carefully consider specific market recovery paths and what tenants are actually doing with their space.
Okay. We briefly mentioned mortgage REITs, M-REITs, earlier. Let's just quickly circle back to them just to reinforce how different they are and their unique risk profile before we move on to the metrics.
Right. Good idea. So remember, equity REITs own and operate physical property. M-REITs invest in mortgages and mortgage-backed securities. They're essentially financial institutions. They borrow money, usually at short-term rates, to buy mortgage assets that yield slightly higher long-term rates. They profit from that spread.
Okay.
What's absolutely crucial to understand is that unlike equity REITs, M-REITs are highly sensitive to interest rates.
Why is their interest rate sensitivity so much more direct, so much more pronounced than for equity REITs?
Because their entire business model is basically centered around that spread between their borrowing costs and the yield on their assets. When interest rates rise, it tends to decrease the market value of their existing mortgage holdings. Why? because the fixed interest rate on those older mortgages looks less attractive compared to new loans being issued at higher rates.
Okay, so their assets lose value.
Right. And at the same time, rising rates make their own short-term borrowing more expensive. So if their borrowing costs rise faster than the yields they're earning on their assets, their profitability gets squeezed directly. It's a double whammy sometimes.
Ouch.
Yeah. This is why analyzing REITs requires a very specialized focus on things like interest rate risk, yield spreads, hedging strategies. It's very different from the property level and operational analysis you do for equity REITs. They really behave more like bond funds or leveraged financial instruments than real estate owners.
That stark difference really underscores why you absolutely have to know which type of REIT you're looking at before you even start analyzing. The sources also briefly mention some other sectors, just illustrating the breadth available. Data centers, cell towers, hospitality like hotels, and industrial like warehouses.
Exactly. And these highlight how the asset class evolves. Data centers and cell towers, for instance, they're almost like infrastructure property types. They've seen huge growth driven by, well, digital economy, internet usage, mobile connectivity.
Right.
Hospitality REITs, owning hotels are super cyclical. Their income comes from daily room rates. So they do great when travel is booming, but they suffer dramatically during economic downturns or, events like a pandemic that just halt travel.
Very offensive.
Extremely. And then industrial REITs owning warehouses, distribution centers, logistics facilities. They've been massive beneficiaries of the rise of e-commerce. Companies need these huge networks of facilities to store and ship goods directly to consumers. Each of these sectors has its own unique demand drivers, operational challenges, sensitivities to economic or technological shifts.
So it's definitely not just investing in real estate. It's investing in a very specific type of real estate with its own unique dynamics. Understanding the sector is just as critical as understanding the specific company itself.
Absolutely critical. And that brings us neatly to the really crucial part. How do you analyze individual REITs effectively? Because this is where standard stock metrics, the ones most people know from analyzing typical companies, can actually lead you way off track.
Okay, you mean standard metrics like earnings per share, EPS, or the price to earnings PE ratio? Why don't those work well for REITs?
You hit the key ones right there. Earnings per share, EPS, and consequently the price to earnings PE ratio that's calculated using EPS are generally not considered reliable or accurate measures for evaluating a REIT's operational performance or its underlying value.
Why not? What's so different about how REITs operate or how they're accounted for that just breaks these standard metrics?
The main culprit, as highlighted clearly in the sources, is the accounting treatment of depreciation, specifically for real estate assets. Standard accounting rules, GAAP, require companies to depreciate the value of their assets, including buildings, over time on their books.
All right.
Now, in many industries, depreciation is meant to reflect actual wear and tear or maybe technological obsolescence of an asset. But with real estate, it's often different. Properties frequently maintain or even appreciate in market value over long periods, even while they're being systematically depreciated on the company's financial statements.
Okay, so the accounting depreciation is just this non-cash charge that reduces the reported net income, but it doesn't really reflect the true economic value or lack of decline in the property portfolio.
Precisely. It's a non-cash accounting entry that artificially pushes down reported net income according to GAAP. This makes EPS look lower than the actual economic performance or the cash being generated by the underlying real estate might suggest. And similarly, the traditional book value of a REIT's assets, which is based on historical cost, minus all that accumulated accounting depreciation that's also heavily distorted and considered pretty much useless as a measure of the current market value of the properties.
Okay, so book value is out.
Book value is out. Net asset value, or NAV, is the preferred measure of asset value, which we'll definitely get to.
All right, so if we can't rely on EPS or PE, what metrics should we be using to understand a REIT's profitability and the cash flow coming from its operations?
This is where these specialized metrics come in. Metrics developed specifically for the real estate industry. The most fundamental of these, the one you hear about most often, is funds from operations, or FFO. It's considered a much more accurate measure of a REIT's ongoing operating performance and the cash flow generated from its property portfolio.
Okay, FFO. How is it calculated? What adjustments do you make to get away from that potentially misleading net income figure?
Right. You start with the GAAP net income figure, and then you make several key adjustments. Primarily, you add back major non-cash charges, and you remove gains or losses from things that aren't part of the regular recurring business. The sources give a clear breakdown.
Okay.
You start with net income, then you add back depreciation expense. You also add back amortization expenses.
Yeah.
Those are similar non-cash charges, maybe for intangible assets or loan costs.
Okay, net income plus depreciation plus amortization. That deals with the big non-cash charges that distort earnings.
Mostly, yeah. You also sometimes add back deferred tax expenses. The logic there is that taxable REITs with, say, moderate leverage and the strategy of reinvesting can often defer a significant portion of their annual tax liability. Their taxable income might look low because of accelerated depreciation rules for tax purposes, leading to this deferred tax item on the income statement. FFO aims to capture more of the pre-tax operational flow.
Okay. And what about gains or losses from selling properties? You mentioned adjusting for those.
Yes, those are crucial adjustments. You add back any losses incurred from selling properties or maybe restructuring debt. And conversely, you subtract any gains from selling properties or restructuring debt.
Why add back losses and subtract gains? Isn't selling properties part of a REIT's business sometimes?
Well, yes, selling properties can definitely be part of a REIT's strategy, managing the portfolio, raising capital. But the gains or losses from those sales are typically seen as one-time, non-recurring events. They don't reflect the sustainable, ongoing income generated from the day-to-day operation of the existing property portfolio, which is mostly collecting rent, right?
Ah, okay.
FFO aims to measure that ongoing operating income. So these non-recurring gains or losses from sales are excluded to get a cleaner picture of the core operational performance.
So just to recap the calculation then, FFO equals net income plus
Fine.
depreciation plus amortization, maybe, plus deferred tax expenses, plus any losses from property sales debt restructuring, and minus any gains from property sales debt restructuring.
That's the standard calculation, yes.
Okay, that clarifies the components and the logic. FFO gives us a much better picture of the cash flow generated from the core business, stripping out those accounting distortions and one-off events. But I understand there's maybe an even more refined metric, one that some argue gets even closer to the actual cash available for distribution.
Yes, exactly. That metric is adjusted funds from operations, or AFFO. You might also hear it called CAD cash available for distribution, or FAD funds available for distribution. Different analysts, different companies might use slightly different names or make slightly different minor adjustments, but the underlying concept is very similar.
Okay, AFO.
AFO starts with FFO and then makes further deductions. The goal is to get a measure that's arguably closer to the true current economic income. Or maybe think of it as the cash that is genuinely available to be distributed to shareholders after you account for necessary ongoing expenditures to maintain the properties.
Okay, so how do you get from FFO to AFO? What other adjustments are made? What gets deducted?
You start with that FFO number we just calculated, and then you make a couple of key deductions for items that either aren't cash received yet or are necessary ongoing cash expenditures that FFO kind of overlooks. The source gives a pretty standard formula. AFFO, FFO, minus non-cash or straight-line rent adjustments, minus recurring maintenance-type capital expenses and maybe leasing commissions.
Okay, let's break those down. Non-cash straight-line rent adjustments. That sounds a little bit technical. What's that about?
It can be, yeah. It relates to how income from long-term leases is sometimes recognized for accounting purposes under GAAP. You see, many long-term leases for commercial properties have scheduled rent increases built into them over the lease term rent bumps, they call them.
Okay. For accounting purposes, GAAP often requires landlords to straight line the rent. That means they recognize an average rent amount over the entire lease term on their income statement each period, even though the actual cash they receive might be lower in the early years of the lease and higher in the later years. So the accounting income statement might show higher rent income right now than the cash they actually collected because it's averaging in those future higher rent payments.
Exactly. The non-cash portion is simply the difference between that straight-lined rent figure recognized on the income statement and the actual cash rent received in that specific period. Since AFFO aims to show the cash available for distribution now, this non-cash portion income recognized but not yet received in cash is deducted from FFO.
Okay, that makes sense. AFFO removes income that's on the books but not yet in the bank. What about the other deduction? Recurring maintenance-type capital expenses and leasing commissions. Why deduct those from FFO? FFO already added back depreciation.
Right, and this is probably the most significant difference between FFO and AFO. It's the core reason why proponents argue AFO is a better measure of true economic income. While FFO adds back depreciation because, yes, it's a non-cash charge, and the properties might not be economically losing value at that rate. The reality is Properties do require ongoing necessary cash investment to maintain their value, their functionality, and their ability to keep generating income.
You mean like fixing roofs, replacing HVAC systems, maybe paying for tenant improvements when a lease rolls over?
Exactly, those kinds of things. These are recurring capital expenditures, real cash going out the door, that are essential to maintain the existing income-generating capability of the property portfolio. Similarly, when a tenant's lease expires and you sign a new tenant, there are often significant leasing commissions paid to brokers and costs to maybe refit the space for the new tenant inducements or allowances. These are also necessary recurring costs of keeping the building occupied and generating income over the long term.
And FFO doesn't account for those cash outflows.
No. FFO adds back the non-cash depreciation, but it doesn't deduct these actual cash outlays that are necessary just to keep the business running sustainably and the properties competitive in the market. AFFO deducts these costs to try and show what's left after accounting for the necessary expenses to keep the properties operating, occupied, and producing income at roughly their current level.
So AFFO aims to provide a more conservative or maybe just more realistic picture of the cash flow that's truly available for distributions because it accounts for those real recurring costs of just maintaining the asset base in good working order.
Precisely. It tries to capture the cash flow after the necessary reinvestment needed just to keep the existing properties humming along effectively.
Yeah.
However, as you kind of alluded to earlier, even though AFFO arguably paints a truer economic picture, FFO is still much more commonly cited and used in practice across the industry.
If AFFO is arguably better, why is FFO still more common? Is it just inertia?
Partly, perhaps, but there's a more practical reason. AFFO relies more heavily on subjective estimates, particularly for those recurring maintenance capital expenditures, or CapEx. Deciding exactly what counts as recurring maintenance CapEx versus, say, a value-enhancing capital expenditure, like adding new wing or a major development cost, can involve significant judgment calls by management.
So it's less standardized.
Exactly. FFO calculations, by contrast, are generally based on figures pulled more directly from the standard GAAP financial statements, using those defined adjustments we talked about. That makes FFO somewhat more standardized across different companies and less open to management interpretation, even if it is perhaps less economically precise. So while many sophisticated analysts absolutely calculate and use AFFO for their own analysis, FFO remains the more widely accepted and reported industry standard metric.
Okay, that distinction between FFO and AFFO and the logic behind all those adjustments is definitely making more sense. But I think walking through a numerical example would really help solidify these concepts, just show how these metrics actually diverge from that simple net income figure. The source included a hypothetical example with some numbers.
Absolutely. A concrete example is always helpful. Let's use that hypothetical provided in the source material to walk through the calculation step by step. Suppose we have a REIT with a starting GAAP net income of, say, $2 million over a specific reporting period.
Okay, $2 million net income. Got it.
Now, according to this example, this hypothetical REIT had accounting depreciation of $50,000 during that period and amortization expense of $35,000. They also reported a net gain from the sale of some properties and maybe some debt restructuring totaling $300,000.
Okay, so using our FFO formula, start with net income, $2, add back depreciation, $50K, add back amortization, $35K. And that net gain from sales, $300, needs to be subtracted because it's considered a non-recurring gain, right? The example doesn't mention deferred tax, so let's assume 0 for this illustration.
Exactly right. So the FFO calculation would look like this. FFO, net income plus amortization plus depreciation net gain on sales. FFO yields $2 million plus $35,000 plus $50,000, $300,000. FFO, it was $1,785,000.
Okay, so in this hypothetical, even though the reported GAAP net income was $2 million, the FFO, which adjusts for those non-cash items and the one-time gain, is actually $1.785 million. Wow, that immediately shows you why just looking at net income can be really misleading for a REIT.
It really highlights the difference, doesn't it?
Yeah. Now let's take that FFO figure of $1.785 million and calculate AFFO using the additional details provided in the source's example. It gives us amounts for those non-cash rent adjustments and the recurring maintenance CapEx leasing commissions.
Right. There's example states there were $305,450 in non-cash straight line rent adjustments during this period and $605,750 in recurring maintenance type capital expenses and leasing commissions. So To calculate AFFO, we start with our calculated FFO, and we just deduct these two amounts.
Okay, starting with our FFO of $1,785,000, AFFO, non-cash rent adjustments, recurring maintenance tape, capital expenses, leasing commissions. AFFO equals $1,785,000, $305,450, $605,750. AFFO $873,800.
That's exactly right. So look at that progression. We started with a reported net income of $2 million. We adjusted that down to an FFO of $1.785 million by dealing with depreciation and the property sale gain. And then we adjusted further down to an AFFO of just $873,800 after accounting for non-cash rent and recurring maintenance. Wow. This hypothetical clearly demonstrates how these metrics get progressively more conservative. Moving from that accounting-based figure, net income, towards measures really intended to represent actual cash flow from operations, FFO, and ultimately the cash potentially available for distribution after covering necessary upkeep, AFFO. The difference between FFO 1.785M and AFFO $873.08 in this example is substantial. It really shows the impact of accounting for that non-cash rent and those recurring maintenance costs.
That step-by-step calculation is incredibly illuminating. It makes the conceptual differences between net income, FFO, and AFFO very, very concrete. It totally drives home the point why relying solely on EPS or PE for REITs is just flawed.
Yeah, that example is powerful precisely because it quantifies the divergence. It shows the real impact of those adjustments. Understanding why these specialized metrics are used is just as vital as knowing how to calculate them.
Absolutely. Now, you also mentioned NAV, net asset value, earlier as the crucial replacement for book value when we're trying to assess a REIT's underlying asset value. If book value is useless because of depreciation, how is NAV estimated? It sounds like it might be complicated.
Well, it's definitely more involved than just looking at a balance sheet figure. Since traditional book value is distorted by all that accumulated accounting depreciation, NAV attempts to estimate the current market value of the REIT's underlying real estate assets and then subtracts its debt. It's intended to give an estimate of what the entire portfolio might be worth if it were sold off today, or perhaps what a sophisticated buyer might pay for that collection of properties. Calculating NAV inherently requires valuing the individual properties, which, as you suspect, isn't as simple as looking up a stock price.
So it involves actually appraising the property somehow. How is that typically done in this context for analysis?
One common method used in NAV estimation relies heavily on the concept of the capitalization rate, or cap rate, applied to the property's operating income. The cap rate is essentially a rate of return metric commonly used in real estate appraisal. It relates a property's net operating income, NOI, to its estimated market value.
Okay, net operating income, NOI, what's that exactly?
NOI is typically the property's revenue, like rents, minus its direct operating expenses, like property taxes, insurance, utilities, routine maintenance, but before accounting for things like mortgage payments, debt service, depreciation, amortization, or income taxes. It's a measure of the property's profitability from its core operations.
Okay, NOI and cap rate. How do those two help estimate market value for the NAV calculation?
The source provides a simple illustration. Let's say a building generates $100,000 in net operating income, NOI, over a year. And analysts determine that, based on recent sales of comparable properties in that specific market, the prevailing market cap rate for similar types of buildings is, say, 8%.
Okay.
You can then use this cap rate to estimate the property's current market value.
So you'd basically use the formula. Value equals NOI divided by the cap rate.
Exactly. In this little example, estimated property market value equals $100,000, NOI, 0.08 cap rate, equals $1,250,000. This estimated market value of $1.25 million is considered a much more realistic representation of the property's current worth than its artificially depreciated book value on the balance sheet. And this estimated market value is what gets used in the theoretical NAV calculation.
Okay. And then to get the net asset value for the entire REIT,
you'd essentially perform a similar estimation process for all the REIT's properties, or maybe groups of similar properties, using appropriate market cap rates for each type and location. You sum up the estimated market values of all the assets. Then you deduct the REIT's total liabilities, particularly its mortgage debt and any other significant borrowings. What's left is the REIT's estimated total net asset value.
And then NAV per share.
Right. You divide that total NAV by the number of common shares outstanding to arrive at the estimated NAV per share. This NAV per share figure is often considered a theoretical estimate of the intrinsic value of each share, based purely on the estimated market value of the underlying assets minus debt. Investors and analysts often compare a REIT's current stock price to its estimated NAV per share. Is it trading at a premium? or a discount to the supposed value of its assets. It's a key valuation tool.
So FFO, AFFO, and NAV per share. Those seem like the essential toolkit for understanding a REIT's operational performance, its cash flow reality, and its underlying asset value. But analyzing a REIT effectively isn't just about crunching these specialized numbers in a vacuum, is it? You surely need to look at the bigger picture, too, the broader environment, the specific company strategy.
Oh, absolutely. 100%. Analyzing a REIT effectively requires a really comprehensive approach. You need to combine your understanding of these specialized metrics with both top-down macro analysis and bottom-up company-specific analysis.
Okay, top-down being the broad economic view, looking at the forest rather than just the individual trees.
Precisely. Top-down analysis involves looking at the state of the overall economy and the major trends that impact real estate demand generally. Key factors include things like overall economic growth, GDP, population and job growth trends in the specific markets where the REIT actually operates. This links right back to our sector analysis, like for residential or office REITs, and critically, interest rates.
Interest rates again. You mentioned earlier their impact is kind of mixed for equity REITs compared to the very direct negative impact on REITs. How does the general interest rate environment influence equity REITs from a top-down perspective?
That's right. It's definitely a more nuanced relationship for equity REITs.
Yeah.
On one hand, rising interest rates can sometimes signal a stronger, maybe even overheating economy, which is generally good for the fundamental demand for real estate, right? More jobs often mean more demand for office space, for housing, for retail space, maybe.
Okay, so strong economy correlation.
Right. However, rising rates also have significant negative impacts for REITs. Firstly, they increase the borrowing costs for REITs, which, as we've discussed, are often quite leveraged companies. This makes financing new acquisitions or developments more expensive, and it directly increases the cost of servicing any existing floating rate debt they might have. A REIT with a lot of floating rate debt will see its interest expense go up almost immediately when rates rise, and that reduces the FFO and AFFO available for distributions.
And I think you also mentioned rising rates can make other investments look more appealing, competing for investor money.
Yes, that's the second major impact, and it affects the stock price directly. When interest rates on safer assets, like government bonds or high-quality corporate bonds, rise, those fixed income alternatives become relatively more attractive to income-seeking investors. This can pull capital away from dividend-paying assets like REITs, potentially leading to decreased demand for REIT shares and putting downward pressure on their stock prices. This can happen even if the underlying property performance is actually stable or improving. So it's kind of a balancing act. A strong economy is generally good for property fundamentals, yes. But higher interest rates are generally negative for REIT share prices because of those increased borrowing costs and the increased competition from bonds. And then capital market conditions more broadly, like just the overall flow of institutional money into or out of real estate or REITs as an asset class, that can also influence share prices in the short term, sometimes causing them to trade at significant premiums or discounts to their underlying NAV.
Okay, so the macro environment, especially interest rates and economic growth, definitely sets the stage. What about the bottom-up analysis then, looking specifically at the individual company?
Exactly. Bottom-up analysis focuses right on the individual REIT's fundamentals. This involves a deep dive into their specific property portfolio. What are the prospects for revenue growth, which comes from, increasing rents on existing leases, signing new leases at higher market rates, maybe adding revenue-generating services to properties, or acquiring new properties that add to earnings, creative acquisitions. You analyze their track record and their future prospects for growing FFO and AFFO on a per-share basis.
And what about the quality of the management team? How do you assess that bottom-up? That seems more qualitative.
It is more qualitative, but it's absolutely crucial in real estate. You look at their experience. Do they have a deep understanding of the specific sector or sectors they operate in? What's their track record in acquiring properties smartly, developing them successfully, managing them efficiently, and maybe even selling them at the right time? Do they have a clear and, more importantly, a successful strategy for improving the performance of their existing portfolio? Maybe by boosting occupancy rates, cutting operating expenses, or implementing property upgrades that attract better tenants or higher rents.
Are they good stewards of shareholder capital?
That's a great way to put it. Are they good stewards of shareholder capital? This qualitative assessment of the management team, their strategy, their execution, it's arguably just as important as crunching the quantitative metrics like FFO and NAV.
So it's really a combination, understanding the economic and sector tides top-down, understanding the specific company's financial health using those specialized metrics, FFO, AFFO, NAV, and judging the quality of the crew steering the ship, management. You mentioned leverage earlier, the debt levels. Is there a way to assess how much debt is, appropriate or too risky for a particular REIT?
Yeah, leverage is a really key factor to watch because, as we noted, REITs often use significant amounts of debt to finance those large property acquisitions. And while using debt can definitely enhance returns in good times, it also absolutely amplifies losses when things go wrong. Assessing leverage involves looking at common ratios like debt to total assets or maybe debt to EBITDA, earnings before interest, taxes, depreciation, and amortization, another cash flow proxy. And importantly, comparing these leverage levels to industry averages for similar types of REITs operating in the same sector.
So there's no single magic number for too much debt.
Not really, no. It varies quite a bit by sector and the stability of the property type's cash flows. For example, a REIT owning properties with very long-term leases to highly creditworthy tenants might comfortably support higher leverage than, say, a hotel REIT with very volatile daily income. But generally, significantly higher debt levels relative to direct peers should be seen as a potential red flag requiring closer investigation.
And you need to look at the terms of the debt, too, not just the total amount, like fixed versus floating rates.
Oh, absolutely critical. The mix between fixed-rate debt and floating-rate debt is hugely important, especially in a changing interest rate environment like we've seen recently. As we discussed, a REIT with a lot of floating-rate debt is going to see its interest expenses shoot up quickly when rates rise. That directly impacts FFO and AFFO and could potentially threaten their ability to maintain the dividend.
Whereas fixed-rate debt offers more stability.
Right. A REIT with mostly long-term fixed-rate debt is much less exposed to rising rates in the short term. Although conversely, they might miss out on the benefit if rates were to fall significantly. Looking at the debt maturity schedule, basically, when their various loans come due and need to be refinanced is also really important. If a REIT has a large amount of debt maturing all at once, especially during a period when credit markets are tight or interest rates are high, that could pose significant refinancing challenges.
Okay, this discussion of leverage and interest rates leads us naturally into thinking about the broader considerations and, importantly, the significant risks involved in investing in REITs. We've touched on some already, but let's maybe detail the main risks investors really need to be aware of.
Certainly. We've definitely highlighted interest rate sensitivity as a core risk, especially for publicly traded REITs. Rising rates can negatively impact their share prices due to competition from bonds, and they increase borrowing costs, potentially squeezing profitability, and maybe even the sustainability of the dividend payout.
And the risks tied specifically to the properties or the sectors they're in.
Yes, property-specific and sector risks are very significant because performance varies so widely across different types of real estate. Choosing a sector that's facing major structural headwinds, the classic example being traditional retail malls grappling with e-commerce, is obviously a clear risk. Investing heavily in a sector that's highly sensitive to economic cycles, like hospitality, hotels, means you face the potential for significant losses in a downturn.
Right.
Conversely, sectors tied to maybe more stable demand, like certain types of healthcare facilities or industrial properties with long leases to essential businesses, might offer a better hedge against recession. But even they have their own specific risks: healthcare funding uncertainty, supply chain disruptions affecting industrial tenants, etc. Misjudging the future trajectory of a specific sector, or even a specific geographic market within that sector, is a major risk for REIT investors.
You also stressed liquidity risk earlier, particularly for certain types of REITs, not just the traded ones.
Yes, and this is a really crucial point, especially for individual retail investors to understand. While publicly traded REITs, listed on major exchanges like the NYSE or NASDAQ, are relatively liquid compared to owning physical property directly, you can usually buy or sell them fairly easily on those trading days. They can still experience periods of reduced liquidity during times of significant market stress, maybe compared to very large cap stocks or highly traded government bonds. But the really significant liquidity risk lies with the other types: public non-traded REITs and private REITs.
Can you elaborate a bit more on those two categories and their specific risks? They sound less common for average investors.
They are less common, but people do get pitched them sometimes. Public non-traded REITs are registered with the SEC, just like publicly traded ones, so they have disclosure requirements. However, crucially, they do not trade on public stock exchanges. This means they are inherently highly illiquid.
Meaning hard to sell.
Extremely hard to sell quickly, yes. Investors typically purchase shares through brokers or financial advisors, often at a fixed price for a period, and there's simply no active open market to sell them on demand. The REIT sponsor might offer limited, sporadic share repurchase programs, often at a discount to the estimated NAV, but there's no guarantee. You could easily find yourself unable to access your invested capital for years. Sometimes the stated investment horizon is 7, even 10 years or more. This makes them fundamentally unsuitable for investors who might need access to their funds before that very long lockup period ends.
So if you invest in a non-traded REIT, you could effectively have your money locked up for a very, very long time with limited options to get it out.
Absolutely. And that illiquidity often comes bundled with other significant risks. There's usually a lack of real-time market pricing, which makes it very difficult to determine their true value at any given moment. A major risk highlighted in the source material is that, unlike publicly traded REITs, whose operational performance and dividend coverage are constantly scrutinized by the market, the dividend distributions from some non-traded REITs might not be fully covered by their actual operational cash flow, FFO or AFFO.
Where would the money for dividends come from then?
Well, the sources warn that dividends could potentially be paid, at least in part, from other sources, like borrowings or proceeds from asset sales, or in some problematic cases, even from the capital raised from new investors joining the fund.
That sounds not good. Almost like a Ponzi scheme structure if they're paying old investors with new investors' money.
While perhaps not always intentionally fraudulent like a classic Ponzi, paying distributions from sources other than sustainable operating cash flow is clearly unsustainable in the long run. It erodes the underlying net asset value per share for all the existing investors. It's basically returning your own capital to you, disguised as income, while potentially charging fees on it.
Paying dividends from borrowed money or new investor capital definitely sounds like a major red flag, not a sustainable business model at all.
It absolutely is a red flag. It's critical for anyone considering a non-traded REIT to look incredibly closely at the source of the dividends. Are they actually covering the payout with their FFO or AFFO? Or are they dipping into other capital sources to maintain an artificially high distribution rate? On top of that, non-traded REITs can also have significantly higher fee structures compared to publicly traded REITs or low-cost REIT ETFs. These can include large upfront sales commissions paid to the brokers, selling them potentially 8%, 10%, even 15% in some cases, plus ongoing external management fees and other expenses that could really eat into investor returns over time.
High fees, illiquidity, potential capital erosion. That's a pretty concerning combination. What about private REITs? Are they similar?
Private REITs are even less transparent. They're generally exempt from SEC registration requirements altogether. This means there is very little public information available about them. They are not required to provide the same level of detailed financial reporting, like independently audited financial statements, that public REITs, both traded and non-traded, are. They are typically only available to large institutional investors like pension funds or endowments, or sometimes very wealthy, sophisticated, accredited investors. And there's a reason for that. They require immense due diligence capabilities and come with extreme illiquidity and very limited transparency.
Okay, so it sounds like for the vast majority of individual investors, sticking with publicly traded REITs or maybe rate ETFs seems strongly advisable, primarily based on the liquidity and transparency advantages alone.
Generally speaking, yes. For reasons of accessibility, liquidity, transparency, and typically lower costs, publicly traded REITs are usually the most suitable option for most individual investors looking for real estate exposure. Beyond these specific risks related to non-traded and private structures, we also had the general leverage risk, which we discussed earlier. Using borrowed money amplifies both gains and losses. Higher debt means higher interest payments, less cash for distributions, and makes the company more vulnerable in a downturn or if rates rise unexpectedly.
And just general market risk applies as well, right? They're still stocks, basically.
Absolutely. As publicly traded securities, for the traded ones anyway, REIT shares are subject to broader market movements that are sometimes completely unrelated to their specific underlying property performance. General economic recessions, geopolitical crises, widespread shifts in investor sentiment away from risk assets, or systemic financial shocks can impact the entire stock market, and REITs are certainly not immune to these big waves. These are systemic risks that are difficult to fully diversify away just by owning REITs. They move with the broader market to some extent.
Okay. And finally, there are the tax consequences of REIT dividends. You mentioned they're often different from typical stock dividends and need careful consideration, especially where you hold them.
Yes, this is a really crucial point that often catches new REIT investors by surprise. As we discussed way back at the beginning, the REIT structure avoids corporate-level tax by distributing most of its income. However, that income, when it flows through to the shareholder, is typically taxed as ordinary income at your regular marginal income tax rate.
Not as qualified dividends.
Generally, no. Most REIT dividends are not considered qualified dividends, which benefit from the lower capital gains tax rates, 0%, 15%, or 20% depending on your overall income bracket, that apply to dividends from most regular C corporations. Ordinary income tax rates can be significantly higher, going up to 37% at the federal level currently, plus potential state taxes.
So that potentially juicy high dividend yield comes with a potentially much higher tax bill if you hold the REIT in a regular taxable brokerage account.
In many cases, yes. Your ordinary income tax rate could be substantially higher than the qualified dividend rate you might pay on other stocks. Now, there can be some tax relief under current law. Certain REIT dividends may qualify for the 20% qualified business income QDI deduction. This was part of the Tax Cuts and Jobs Act of 2017. If the dividend qualifies, it means you might only be taxed on 80% of that ordinary income portion of the dividend.
Okay, so the QBI deduction helps.
It helps, yes. But even with the QBI deduction, the effective tax rate on REIT dividends can still be higher than the preferential qualified dividend rate for many investors, especially those in higher tax brackets.
Given that potential tax hit, the sources strongly recommend holding REITs in tax-advantaged accounts whenever possible.
That is definitely the most common recommendation from financial planners for this very reason. Holding REITs inside accounts like a traditional IRA, a Roth IRA, or a 401k allows those dividends, which are taxed as ordinary income, to grow tax-deferred in a traditional IRA or 401k, or potentially completely tax-free in a Roth IRA. This can significantly mitigate or even eliminate that annual tax drag on the income generated by the REITs. Over the long term, this tax sheltering can make a really big difference to your net after-tax return compared to holding the same REITs in a taxable brokerage account.
Okay, that's a really important practical tip. So we've covered a ton. The core concept, the different sectors and their unique dynamics, the crucial specialized metrics FFO, MFO, NAV per share, and the significant risks, including those tricky non-traded REITs and the tax implications. How does an investor actually, get started and maybe build a portfolio in this space?
Well, for most individual investors, the easiest and generally most recommended ways to get started are either by buying shares of individual publicly traded REITs directly on a major stock exchange, or perhaps more commonly, by investing in REIT mutual funds or exchange-traded funds, REIT ETFs. These funds hold a diversified portfolio of many different REITs, giving you instant diversification across sectors and companies. You might also find specific REIT fund options available within your workplace retirement plan, like a 401k.
So the actual process for buying publicly traded REITs or REIT funds is pretty similar to buying other stocks or funds that people might be familiar with.
Exactly the same process, yeah. You'd open a brokerage account if you don't already have one, deposit funds, and then use the research tools and screeners provided by your broker to identify individual REITs or REIT funds that seem to align with your own investment goals and risk tolerance. Once you're invested, of course, it's crucial to monitor your holdings over time, understand the strategy, and be aware of any associated costs like brokerage commissions for trading individual REITs or the ongoing expense ratios charged by mutual funds and ETFs.
And you've really emphasized diversification multiple times throughout this deep dive. How important is it specifically for REITs, and how do you achieve it within the REIT space itself, not just using REITs to diversify your overall portfolio?
Diversification is absolutely key. Just like in any investment portfolio, it's fundamental to managing risk and potentially enhancing long-term returns. While adding REITs to your overall portfolio of stocks and bonds provides diversification by adding real estate exposure. If you choose to hold more than just one REIT, or if you're picking individual REITs instead of a broad fund, you definitely need diversification within your REIT holdings themselves.
Okay, how do you diversify effectively within REITs? The sources laid out some specific strategies there.
Yeah, one major strategy, probably the most important, is to diversify across different property sectors. We've spent a lot of time discussing different sectors: retail, office, residential, industrial, healthcare, data centers. They all have very different economic drivers, different risks, different cycles. So don't put all your REIT eggs in one basket. Don't just invest in retail REITs or office REITs, no matter how appealing one might seem at a particular moment.
Right.
By spreading your investments across different types of real estate, residential, healthcare, data centers, industrial, maybe even some of those lesser-known specialized sectors we mentioned, you significantly reduce the risk that comes with a downturn or a major structural change hitting any single property type hard.
Like your example earlier. If retail is struggling because of e-commerce, maybe your data center or healthcare REIT holdings are doing well and help balance out the overall performance of your REIT allocation.
Precisely. The sources use that exact kind of example. Diversifying across sectors helps smooth out the ride and reduces the impact of those inevitable sector-specific shocks. And, it's also probably prudent to focus your investments on sectors where you feel you have a decent understanding of the fundamental drivers behind their business.
Diversifying geographically was another key strategy mentioned in the sources. Why is that so important for real estate?
Yes, because real estate is inherently local. It's fundamentally a local or regional business. Performance and property values can vary dramatically from one city to another, one state to another, even one neighborhood to another. It all depends on local economic conditions, population trends, local supply and demand dynamics. So investing in REITs that own properties spread across diverse geographical markets, multiple states, different types of locations like urban and suburban, maybe even internationally, though our focus is U.S. today, helps mitigate the risk of a regional economic downturn hitting your portfolio hard, or maybe a specific local crisis, like a natural disaster impacting one area, or the closure of a major local employer tanking a specific market.
So basically, a REIT spread across various different economic hubs is inherently likely to be more stable than one that's heavily concentrated in just a single, maybe undiversified regional market.
Exactly. Unless you have extremely high conviction about that specific market and are comfortable with that concentration risk, geographic diversification generally makes sense.
Okay, so diversify by sector, diversify by geography. Beyond just spreading investments out, the sources also emphasize focusing on quality and performance at the individual company level. What does quality really mean in practice for an individual REIT, beyond just looking at FFO or AFFO growth?
That's a great question. Quality here means looking for REITs run by strong, experienced management teams. Teams that have a proven track record, not just in talking a good game, but in actually acquiring, developing, and operating properties successfully within their specific sector or sectors. It means analyzing the quality of their property portfolio itself. Are locations good? Are the buildings well maintained? Who are their tenants, and are they financially healthy? It also means looking for solid financials beyond just those operational metrics we discussed. Does the REIT have a strong balance sheet with reasonable debt levels compared to its peers? Do they have ample liquidity, enough cash and borrowing capacity to weather storms or seize opportunities? Is their debt maturity schedule manageable? A history of consistent FFO and AFFO growth per share, high and stable occupancy rates across their properties, and maybe a track record of making smart strategic acquisitions or developments that genuinely enhance the portfolio's value. These are all indicators of a potentially high-quality, well-managed REIT. It's really about picking good companies with sound strategies, not just grabbing any company that happens to be in a currently popular sector.
And the final strategy mentioned was monitoring and rebalancing over time. Seems pretty standard for any investment.
Yes, but perhaps even more important with REITs, given the sector and geographic dynamics. It's essential for maintaining your desired level of diversification and risk exposure over the long haul. You need to regularly review your REIT holdings. Do they still fit your overall investment goals? Has your risk tolerance changed? Markets change constantly, sectors perform differently over time, and the fundamentals of individual REITs can definitely evolve, sometimes for the better, sometimes for the worse.
So, rebalance periodically.
Yeah, rebalance periodically, maybe annually, or whenever your allocation drifts significantly from your target. For instance, if one particular sector, or even one individual REIT, has performed exceptionally well and grown to become a disproportionately large part of your total portfolio, you might consider trimming some of those holdings, taking some profits, and reallocating that capital to maintain your target asset allocation and keep your diversification levels intact. It's an active, ongoing process of managing your portfolio.
That makes perfect sense. It's not set and forget. Okay, one final nuance the sources touched on, which relates back to the structure. Why don't REITs tend to appreciate in share price as rapidly as, say, some high-flying technology stocks or other traditional growth stocks?
Yeah, that goes right back to that 90% payout rule we talked about right at the beginning. Because they are legally required to pay out at least 90% of their taxable income as dividends, REITs simply retain significantly less cash compared to many other types of companies. Think about a traditional growth company, maybe in tech or biotech. They might retain the vast majority, maybe all of their earnings, and reinvest that capital aggressively back into the business, into R&D, expanding production, making large strategic acquisitions, entering entirely new markets. All of that reinvestment is intended to fuel rapid internal growth and hopefully lead to significant share price appreciation over time.
Ah, right. So a growth company plows its profits back in for future appreciation, while a REIT is structured to distribute most of its profits as current income to shareholders.
Precisely. Less retained cash means REITs have less internal capital available to fund really aggressive growth initiatives purely from their own earnings. Now, they do grow through developing new properties, acquiring existing ones, but they often have to rely more heavily on external capital markets. That means issuing new equity, which can dilute existing shareholders, or taking on more debt, which increases financial risk to finance those large capital expenditures. Plus, just mechanically, when a significant dividend is paid out, the stock price typically tends to fall by roughly the amount of the dividend on the ex-dividend date. That also naturally tempers the rate of capital appreciation compared to non-dividend or very low dividend-paying stocks that are reinvesting heavily in their own growth. So the total return from REITs is often heavily weighted towards that income component, the dividend yield, rather than being primarily driven by capital gains.
Okay, this has been an incredibly detailed and, I think, really useful deep dive. Let's try to quickly unpack everything we've covered here. We started by looking at what REITs are at their core, right? Defining that unique structure driven by those 75% and 75% and 90% rules, and understanding the significant tax benefits and the resulting high dividend potential that structure provides, while also considering the trade-off, the implications for retained earnings and internal growth.
Right. Then we toured the incredibly diverse landscape of real estate sectors where these REITs operate. We went from familiar malls and apartment buildings to more specialized things like data centers and healthcare facilities. And we really dissected how global trends like e-commerce and changing demographics, plus regional economies and specific technological shifts directly impact the success and the risks within each of those different property types.
And crucially, I think, we armed ourselves with the essential specialized metrics required to actually analyze REITs properly: FFO, AFFO, and NAV per share. We spent time understanding exactly why standard stock metrics like EPS or PE are often misleading, mostly because of that accounting depreciation issue. And we walked through the logic and the calculation steps behind these vital real estate-specific figures. We even worked through that numerical example to make those adjustments really concrete and show the difference they make.
Yeah, and we face the significant risks head on too. We talked about the macro level exposures like interest rate sensitivity and just broader market movements. We covered the specific challenges of property sector downturns, the risks of using leverage, and we highlighted the critical issues of liquidity, transparency, and potentially unsustainable dividend practices, particularly associated with those non-traded REITs. We also made sure to clarify the important tax implications of REIT dividends, that ordinary income treatment, and the common strategy of using tax-advantaged accounts to mitigate that tax hit.
And finally, we touched on some practical strategies for actually getting started and building a potentially more resilient REIT portfolio, focusing on diversification across sectors and geographies, emphasizing the importance of evaluating management quality and the overall financial health of the company, and remembering the need to actively monitor and rebalance your holdings over time.
So, after all that, what do you think is the single most important lesson, the key takeaway from this whole deep dive into analyzing REITs?
That's a good question. I think the biggest, most fundamental takeaway for me is that while REITs offer a really compelling and frankly accessible way for individual investors to participate in commercial real estate, benefit from potential diversification away from just stocks and bonds, and access potentially attractive income streams, they are definitely not simple investments to analyze effectively. They really require a specific toolkit and a deeper understanding. You absolutely cannot be solely swayed by just seeing a high dividend yield posted on a financial website. True, informed analysis requires really understanding the underlying business of owning and operating real estate. It requires mastering those specialized metrics, FFO, AFFO, NAV. It requires critically evaluating the quality of the management team and understanding the specific sector and geographic exposures of the portfolio, and having a very clear grasp of the unique risks involved, especially if you venture beyond standard traded REITs and, of course, the tax implications. It's really about looking past that headline yield to the operational reality, the financial health, and the valuation relative to the actual assets and cash flow being generated.
It's about understanding the property itself, the people managing it, and the numbers that truly reflect its performance, not just relying on standard accounting figures that can be misleading in this specific asset class.
Exactly. Okay, so here's maybe a final provocative thought for you, our listener, to mull over after this deep dive. Considering how quickly the world is changing right now, think about the accelerating shifts in office work patterns, the ongoing dramatic evolution of the retail landscape, the increasing prominence of newer sectors like data centers, cell towers, maybe even entirely new categories of real estate tied to things like renewable energy infrastructure or logistics technology. What new considerations might be emerging for investors trying to analyze and diversify across REIT sectors effectively in the coming years? How will REITs themselves, and perhaps the analytical frameworks we use to evaluate them, need to adapt as the very definition and the commercial use of real estate continue to evolve so rapidly in the 21st century?
That's a fascinating question. The underlying assets and the powerful forces shaping their value are definitely constantly in motion. It requires ongoing vigilance.
It certainly does. Well, that's our deep dive into analyzing U.S. REITs for today. We really hope this has given you a much clearer picture and, perhaps more importantly, some new essential tools for understanding this complex, sometimes confusing, but potentially rewarding corner of the investment world.